David Parker.
Thank you, Mr Speaker. I rise on behalf of the Labor Party to speak in respect of the 5-year funding agreement of the Reserve Bank, which is being discussed at the moment. The Labor Party is supporting the motion, but makes the point that there's a lot more reform needed in respect of monetary policy. And as Russell Norman has said, and David Cunliffe before him has agreed, there is a problem with the current monetary policy in New Zealand. What was world-leading and right at the time when our monetary policy was introduced in the late 1980s, when New Zealand had rampant and out-of-control inflation, now needs updating because it's had some perverse effects in the last decade. The world, most notably, has changed substantially in the last 2 or 3 years as a consequence of the international financial crisis and the lessons that have been learned from it. I want to restate my view and the Labor Party's view as to some of the current problems with monetary policy. There is no doubt that for New Zealand to improve in our relative wealth amongst the countries of the world and to maintain the quality of services that we want in health and education, we actually have to do better relative to the rest of the world than we have been better relative to the rest of the world. And in order to do that, we actually have to increase our growth in exports. At the moment, we're running quite a large current account deficit, and we can't become wealthier as a country until we export more than we import. And in those exports, I'm including the investment flows, the interest that we pay to overseas lenders and the dividends that flow to the overseas owners of New Zealand assets. And we can't do that if the settings in our economy aren't conducive to an export economy. And our settings at the moment are not conducive to an export economy, and monetary policy is one of those settings that's not quite right. And that has a couple of impacts on New Zealand. It's now abundantly clear that New Zealand has long-term interest rates that are higher than those that are paid by the competitors of our New Zealand export businesses when they're operating in other parts of the world. So the New Zealand business trying to invest in sophisticated plant or machinery to improve their productivity and to compete against international competitors, be they in China, the United States or Europe or Japan, the New Zealand manufacturer faces higher interest rates because we've got ourselves on this track of perpetually higher interest rates. Now, I know at the moment our interest rates aren't higher than Australia's. They're pretty much the same as Australia's. But that's pretty rare in the longer term, and it's because Australia is actually one of the few countries in the world that's actually still booming. One of the few Western countries in the world still booming. And if you look at us compared with all of those other countries, be it Japan, Australia, European areas, our interest rates are higher. So our exporters are facing that disadvantage. In addition to that, they face an incredibly volatile currency. Now, it has been said by some economists that our currency, our commodity prices and currency act as a hedge to each other, and that may well be true in respect of the dairy sector, where if the dairy prices go high, the currency reacts and goes high, and conversely, when dairy prices drop, the exchange rate drops a little, and so there's a bit of a natural hedge there, perhaps in respect of those major commodities like dairying, but that's not true of manufactured goods. I saw a presentation recently from Rick Boyven from the New Zealand Institute, who was analysing the difference between New Zealand's economy and economies of other developed countries that are wealthier than us. And he looked at the issue as to whether we could increase we could bridge the likes of the gap between us and Australia by increasing either mineral extraction or agricultural output. And it was abundantly clear that the difference between New Zealand and Australia in respect of minerals is only about 10% of the difference. And although the government was even a couple of months ago saying, well, this was going to be the panacea for New Zealand and that moving on minerals in the national parks and the like would have bridged the gap in a large way between New Zealand and Australia, that was never the case. It was never the case in theory, and of course it's never going to be the case in practice now anyway, because the government has now abandoned its attempts to mine in national parks. So if we're going to actually get wealthier as a country relative to other countries and get back higher up the OECD rankings, we have to increase our exports. And at the moment, our monetary policy, with the effects on a higher exchange rate, and higher entrenched interest rates is actually curbing their performance. And if it's riskier for the exporters relative to investment in export industries or competitive producers of those same manufactured goods in other jurisdictions, well, it is absolutely true that there will be less investment in expansion of those important export industries in New Zealand than would be the case otherwise. And so we will not bridge that gap as we ought to. I agree with what Russell Norman had just said in terms of the perverse effects of monetary policy in recent years. And I'm someone who can actually stand here with my hand on heart and say that I've been saying that since I've been here. I was on the Finance and Expenditure Committee when I first came here in 2002, and I was saying that the interest rate differential between New Zealand and Australia was driving inflows of capital into New Zealand that were being lent by the banks on ever higher lending margins and ever higher loans on the same securities. And those higher interest rates were, in fact, through the liquidity being introduced into the New Zealand economy, driving the very consumption pressures that higher interest rates were meant to curb. The interest rate differential between New Zealand and the rest of the world has become a problem. It has become a problem, and therefore we need more tools for the Reserve Bank to control it than just the interest rate lever, because the interest rate lever is having two perverse effects. The one that I've said, it's been driving liquidity into the country, and feeding the consumption pressures it's meant to be curbing. But as well as that, given our reliance on overseas capital, every time we have an increase in interest rates in New Zealand, where does the money go? We export it overseas. We actually increase our current account deficit through this interest rate differential between New Zealand and overseas, because the majority of money that the banks have to fund their operations in New Zealand, their lending to New Zealand companies and individuals, is sourced from overseas lenders. And so when the interest rate goes up, then the major beneficiaries of that money, that extra interest that's being paid by the New Zealand borrowers, are the overseas lenders. There's another strange effect that we have currently. Because we've got a current account deficit, we're very reliant on overseas capital flows. We're seeing increasing pressure by overseas interests to buy more New Zealand assets. And the government's deeply conflicted on this. On the one hand, they say, they don't want all of the Crayford farms to be sold to overseas interests, be they Chinese or otherwise. But then they say, we're happy with the number of small ones to be. I can't see the difference between one block of 10 farms or one block of 20 farms and 20 small transactions personally, but they seem to see some difference. So they wring their hands about that particular problem. But then they say, we're going to loosen the foreign exchange, the foreign investment rules in New Zealand, which I find completely inconsistent. They say, and Bill English, and I'm quoting him, he says he doesn't know what a strategic asset is. Well, I tell him we know what a strategic asset is in the Labour Party. Anything that has monopoly characteristics as an infrastructure asset is, in my view, strategic for two reasons. One, it's going to be extracting monopoly rents at one level or another. And two, it's going to be important to the wider functioning of the economy, because those infrastructure assets have importance beyond the business unit, because they facilitate the operation of other businesses. So those sorts of assets ought not to be sold overseas. Why is it that we're under such pressure to sell those assets overseas? Because we've got such enormous current account deficit. Why is that? Well, it's partly because we don't save enough. What's the government done in response to that? Cut the incentives to KiwiSaver. Again, going in the wrong direction. But another problem, this is another problem that we have from higher interest rates in New Zealand, because it's cheaper for an overseas owner to own a New Zealand business borrowing from offshore credit lines than it is for a New Zealand purchaser borrowing from New Zealand banks. How can that be in New Zealand's national interest? That we actually have a set of policy settings that mean that it is cheaper for an overseas person to buy a New Zealand asset than a New Zealand purchaser. In other words, all other things being equal, they can afford to pay a higher capital price for the same asset. That has got to be wrong. It is an outcome of current monetary policy settings. It's also an outcome of current savings and investment policy, which we can't cure through monetary policy, but monetary policy can and should do some of the work. We need more focus on liquidity and flows of money as well as interest rates. The single reliance of the Reserve Bank on an interest rate tool is out of date. It is not in New Zealand's interest. The National Party has their head in their sands. Rod Orm's article, if I could finish on this, says that given the new understanding growing overseas about the need to manage better manage fiscal misalignments in order to promote greater economic stability, plus the shift at home by the Reserve Bank and the Labour Party, monetary policy could become a defining issue at the next election. I suspect that's putting a bit high because most people don't understand this, but it ought to be. It ought to be because it is a very important issue and this is a missed opportunity